All right, welcome back. This is a pretty depressing, if not revealing, stat, right? Nearly 40% of Americans have said that they have less than $500 in cash savings. Now, so many questions come to my mind about that, right? What about any unforeseen costs, like those one-offs that seem to hit all the time at the worst time? What about retirement plans? I mean, it paints a pretty bleak picture of Main Street, if you ask me. Now, it goes a long way in explaining that University of Michigan consumer sentiment number we got for April of last week. It hit an all-time record low of 47.6, and that marks the worst reading in the survey's 74-year history. Wow. It plummeted from a 53.3 in March and missed the economists' expectations of 52. That's bad. So maybe a low savings rate is really depressing the consumer. I don't know. Let's bring on our money and retirement guy and get his take on these readings. Please welcome to the show, Mr. Craig Bolanos. He's the co-founder and partner at VestGen Advisors up in Chicago. Thanks for being on the show, Craig. Really appreciate you coming to us. That's a really low $500. It's almost like having nothing.
No, it's almost like having nothing. And you know what? And this is good. I mean, you and I take a break from Wall Street for a minute and we just talk about Main Street. And on Main Street, affordability has been a big deal in all things politics. And I think affordability is exactly what this speaks to, because you take the high cost of energy, the high cost of shelter, you have a fractured economy that's not just a K. I think it's special K. And I'm not talking about everyone's favorite cereal from the 70s and 80s. And this is just one more proof, just as hardship loans are from 401ks, that people are having a tough time out there. And when you have a tough time and you're losing the ball game, you just got to get back to the basics. I mean, it's one with the basics. And Scott, that means things like budgeting.
Yeah. Well, so, I've seen some research, and we had a guest on the show probably last week, that, this K-shaped economy, right, where the upper 20% of incomes are doing well, the bottom 80% of incomes are struggling. And I believe that's the case. I don't know if it's 80-20 per se, but that's what we'll go with. But he's also trying to intimate this issue where the upper 20% they're enjoying this, involved in and enjoying the rally that we're having here today in the stock market. They've had to suffer some downs with the Iran war, but still it's back to where it was or higher than it was on February the 27th when we kicked this whole thing off. And there seems to be some anger or resentment from that lower 80% of incomes because of what the other upper 20% are getting to enjoy. Now, we're happy to have them continue to spend that upper 20% of incomes, but there's an anger, I think, on that lower part of that K, where those folks are paying $100 to fill the truck up, that 25-gallon tank, $4 a gallon. That's bad. And you've got your insurance for your car, your home, and your health is through the roof. There hasn't been any relief there. The bottom 80% of incomes is still really struggling, and I can understand some sort of resentment there. Can you?
Yeah, I understand the resentment because we're all humans. And a part of the human condition is to long for and want and desire that through which we don't have. Scott, I'm a Chicago guy. Do you know how long I've been waiting for a legitimate quarterback to actually make the Chicago Bears good again? We now have one. So I've resented Green Bay for years in the same way I understand the current fracture in the U.S. economy causing resentment. It's just natural. It's human. No one should be faulted for it. I understand why the condition is what it is.
So you see a ton of people that come through your practice. You guys are very, very successful. How does this comport with what you see? I mean, do people that you talk to have a very, very thin line of say, buffer to help with any unforeseen costs, or are they much more comfortable and really are you only dealing with those upper 20% of incomes?
You know what? Listen, we're a multifamily office for regular people, but most of the clients that we deal with aren't in the bottom part of the K. They've saved and invested, grown and protected, and come to VestGen Wealth Partners because they want strategies to enhance everything that's end-to-end financial. But I'll tell you this, as a testament, our clients know and engage in conversations with us where they realize the true threat to wealth in the future for those that have it is not recessions and not the cyclicality of economics. It's a full redistribution if too many voters eventually feel disenfranchised. That's how things can change. And the further this gets, the closer we get to what that future state might be. And that's not a good place.
Right. So I'm going to sum it up. I want to kind of make some delineation here. You're a retirement guy. You handle, like you said, small family office where you take care of people's retirement, which generally means, I would say, your retirement money, your anything for education for your children, and then maybe some health money to put aside for anything that might come down the road. But those are the three things, that the big ones that you probably look after for most of your customers. I'm guessing. If I'm wrong, I'm wrong a little bit. But you're not a hedge fund manager, so you've got every single person you have there has got something tailored, 100% bespoke to them. You're not trading a big fund of money. You're actually looking after individual accounts. When the markets get like this and they get so really volatile, how much chopping and changing are you doing, or do you kind of just put a plan in place and let it ride out?
No, I think it's important that we always relate the existing investment program back to the family's cash flow, which is ultimately their retirement plan, to make sure they understand how the VIX, or the volatility, is not going to get them unretired. However, we have a demand. It's a demand from our clients, and that's a demand not just to sit idly by on our hands and say, don't worry. No. If you take care of the downside, the upside will always take care of itself. History taught us that. So we do manage, trade, and rebalance around positions, but we are going to invest through retirement, not simply invest up to retirement, in order for people to be long-term successful.
I always love what you have to say. Everybody says they replay your segment a lot just to make sure they got it all. Great knowledge. Super to have you on the show. Thank you very much, Craig. We love having you on. Craig Bolanos, he's a co-founder and wealth partner at VestGen Wealth Partners up in Chicago. Thanks for being